I'm in San Francisco for REITwise 2011, Nareit's Law, Accounting, and Finance Conference. Joining me is local, Jay Leupp, president of Grubb Ellis AGA Mutual Funds. Jay, thanks for joining us.
Oh, it's good to be here, and welcome to San Francisco.
Thank you. Let's start by talking a little bit about some of the major acquisitions we've seen in the REIT space. We've seen a couple of big-name deals get done. What has that done to REIT valuations, and what are your expectations going forward?
Well, we've seen a fair amount of activity in the M&A side of the business in the first quarter of this year. We expect that activity to continue. We do think it provides a boost to valuations as more and more investors, as they look at the deals that have already been announced, AMB, Prologis, Inventus, NHP, two public-to-public mergers, investors start to look for other public companies that potentially could be acquired. And that, I think, has given a lift to some potential acquirees in the marketplace. So I think it's going to give valuations a floor. Generally speaking, the managers of large cap REITs are looking for accretive investment opportunities, whether it's development, acquisitions, or M&A activity. And right now, M&A activity, given the ability to issue common stock and debt relatively inexpensively, that's going to be a popular way to grow going forward this year.
And in a previous interview that we did with you, you described the REIT market as a stock picker's market at that time. Are we still in such a climate?
We are. I think a little less so because we're trading at a little bit more of a premium to net asset value. By public market analyst estimates, we're probably at a 15 to 20% premium to NAV. So I believe actually we're always in a stock picking market, but I think that given a number of REITs now are trading at a premium to NAV, it's an even more difficult stock picker's market. We're taking in our two U.S. funds, Grubb Ellis AGA Realty Income and Grubb Ellis AGA U.S. Total Return, a barbell approach. We're buying both large cap names that are trading at premiums to NAV where we believe the premiums are warranted, where management teams with proven growth records are going to grow earnings, we believe, going forward. And then we're also buying some of the value names, stocks that are trading at a discount to NAV, either because we think they're going to be acquired or we think that management teams are going to turn the situations around and drive value for shareholders.
And if you had to pick out either the biggest issue or biggest concern in REIT investors' minds right now, what would that be?
I think fear of the unknown right now. We've had such a good run and such an amazing recovery. The stocks, the common stocks in the REIT space on average are up 25% annually over the last 2 years from a very dark bottom. And I think now investors are asking themselves, what could go wrong from here? And I think that our only answer to that would be super macro shocks, global events that work their way back into the U.S. capital markets. From a fundamentals perspective, the picture looks pretty good. I mean, the stocks are trading at a bit of a premium to NAV, but we expect dividends to be reinstated this year on the part of companies that either discontinued or reduced them during the downturn. And we actually expect 6 to 8% dividend growth on average as both reinstatements occur and companies raise their dividends to be able to distribute 90% of their taxable net income. So we're relatively bullish.
Great. Sounds like an excellent time. Great. Thanks very much, Jay.
Good to see you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.